Hi guys, Todd Croy here with American Security Mortgage in Charlotte, North Carolina. We help people buy homes. I actually had a friend of mine ask me about adjustable rate mortgages and how they work. What does everything mean? So you'll see like adjustable rate mortgages, 7 year, 10 year, 5 year mortgages. And where you find out what kind it is when you get a quote for a rate will be right here. When they say, hey, it's a 6% 10 year ARM, meaning the first number here is that the first number is the fixed rate period, meaning this loan, if it were 6% on a 10-6 SOFR ARM 515 at a 2.75% margin, that means how long would it be fixed? It would be fixed for 10 years. The second number, this 6, tells me that after the first 10 years or 120 payments, that my next fixed payment of time will be only for 6 months. Sometimes you'll see it 10/1, and that 1 usually means it's just going to change annually. If it's 10-6, that means every 6 months it's going to change. All right. So we'll look at the next part of it. So far is the secured overnight financing rate, and this is something we call our index. So we take our margin 2.75 plus the index, which right now is 3.02%. Now, this is the NewYorkFed.org website, and all you have to do is Google Federal Reserve Bank of New York and SOFR, and you'll end up getting this website. So if we took 2.75 plus 3.03, that would tell us we're at 5.08% would be the margin today, plus the SOFR rate would be our new rate if it were to adjust today, right? So that's how it works. Again, they just go to the secured overnight finance rate, 3.02, and then we would just add it. So it'd be actually 577, all right? Hint, you can just Google SOFR and New York Fed, and it'll take you right to that website that I just was on. So ARM, of course, adjustable rate mortgage, guys. I forgot to mention that at the beginning. So you'll see it says it's 10-6 SOFR ARM 515. What does the 515 mean? The 515 represents the caps for the changes in your interest rate. The first 5 says that my first adjustment, so after my fixed rate period, whether it be 5 years, 3 years, 10 years, 7 years, my first adjustment can be up to 5% plus the rate I'm quoted today. So if I were quoted 6% today, that life cap would be 11%, or the maximum it could adjust on the first adjustment could be all the way to that 5%. The next number, the middle number, this 1, tells me that every 6 months, this rate can only go up or down 1%. So it limits the amount of movement that can take place every 6 months. And then the last 5 here in this case, right? These could be different numbers, but in this case, the last 5 says I can never have a higher interest rate than the current interest rate I have plus the 5%, which is my life cap. So the first 5 represents the first, how much percentage can my first payment or my first interest rate change. My next one is every adjustment after that, how much can it go up or down? And then the final one tells me what is my life cap, meaning what's the highest the rate can ever be. So let's look at an example. Let's say I got quoted a 6% interest rate on a 10-6 SOFR ARM 515 at 2.75%. My initial interest rate is 6%. And so for 120 payments or 10 years, my rate will stay at 6% the entire time. It will not change. So if I were to sell prior to that period of time, nothing ever happens. It's no different than a 30-year fixed mortgage. Then the next number, the 10, tells me that it's fixed for that 10 years we were talking about, right? 6 tells me that after the 120 payments, right? So 10 years times 12 is 120 payments. I will have a rate change. And that rate change, we talked about it, will be this margin plus the index. And it will stay fixed for 6 payments. It can't move for 6 payments. And then and the maximum it could go up is 5%. Remember that? Meaning 11% in this case. And then after the first 6 payments, so we're talking 127 payments now, right? It could go up or down 1% for the next 6-month period. All right, so that's how much you can go up or down after our first adjustment. Now, let's say we got all the way down. We're finished. We've done our 120 payments at 6%, and now we are moving into our next payment, 121 payments. And we go out and we look on the internet, and it tells me that today my SOFR rate right here, right, is 3.02. Well, if it were 3.02 and 121 for my 121st payment, for the next 6 months, my interest rate would be 2.75 plus 3.02. So 577. So it actually would go down a little bit. So this can go up or down after that period of time. And the reality is we've seen these rates be lower in the past. So our goal here is to try to save. If today's rate were 7.25 on a 30-year fixed, and we could get a 6% ARM rate fixed for 10 years, it's a pretty safe mortgage, and there's a good chance we'll have a refinance sometime, a refinance opportunity sometime if we want to lock it into a 30-year fixed. So a lot of people get scared of these things. Just know that there is a lot of safety. There's 10 years worth of safety in these loans. And if we do a 7-year loan, it's 7 years. If it's 5, it's 5 years. It just depends upon your risk tolerance. So work with your mortgage professional on adjustable rate mortgages, and you might be able to save some money as you buy your new home, right? Take care, and let me know if you need any help at all looking at your different mortgage options. I'm here to help out. Take care. Bye now.